this video, we're going to cover one of the most important accounting adjustments you'll encounter: deferred revenue, also known as unearned revenue. By the end of this session, you will understand what deferred revenue is, why we defer revenue, the accounting principles behind it, how to calculate deferred revenue, the journal entries involved, where it appears in the financial statements, how it affects profit, what happens when invoices are eventually recognized as earned revenue, how deferred revenue works over several accounting periods and common mistakes. Let's begin. Deferred revenue arises when a business receives payment or invoices a customer before it has actually earned the revenue. In simple terms, the customer has paid, but the business still owes goods or services. Because the work has not yet been completed, the business cannot immediately recognize all of that amount as revenue. Instead, the unearned portion must be deferred to a future period. Think about annual software subscriptions, service contracts, insurance premiums, maintenance agreements. For example, a customer pays £12,000 on 1st of October for a 12-month support contract. At the point of payment, the business has not yet provided 12 months of support. The business provided only 1 month support. Therefore, it cannot recognize the entire £12,000 as revenue immediately. Only the portion relating to services already provided can be recognized as revenue. The remainder becomes deferred revenue. Deferred revenue is based primarily on the accruals concept. According to the accruals concept, revenue must be recognized in the correct accounting period when it is earned. This means revenue follows performance. If a business has not yet delivered the goods or services, then revenue has not yet been earned. The business still has an obligation to the customer. This obligation creates a liability. That liability is called deferred revenue. Why is deferred revenue a liability? Let's think logically. Suppose a gym receives £600 in January for a 12-month membership. The customer pays on day 1 in January. The gym hasn't earned all £600 yet. Gym earned £50 revenue in January. The gym still needs to provide access for the next 11 months. The gym owes a service. That obligation exists until the service is provided. Therefore, deferred revenue is classified as a liability. In accounting terms, a liability is a present obligation arising from past events which is expected to result in an outflow of economic benefits. The gym has an obligation. Until that obligation is fulfilled, the unearned amount remains a liability. This liability appears in the statement of financial position. Let's look at a simple example. A company receives £24,000 on 1st of August for a 1-year maintenance contract. Year end is 31st of December. The contract runs from August to July, 12 months total. By 31st of December, 5 months have passed and 7 months remain. Monthly revenue is £2,000 per month. Revenue earned is £10,000. Deferred revenue is £14,000. At year end, revenue recognized in profit or loss is £10,000. Deferred revenue in the statement of financial position is £14,000. Let's now look at the accounting entries. Customer pays £24,000. We debit bank and credit deferred revenue. The business now owes services. At year end, in December, after 5 months, revenue earned is £10,000. We debit deferred revenue and credit revenue. The liability reduces and revenue increases. This reflects the fact that the business has now earned part of the revenue. Deferred revenue appears as a liability in the balance sheet, usually under current liabilities if expected to be earned within the next 12 months. If part extends beyond 12 months, it may be split between current liabilities and non-current liabilities. Only the earned portion appears as revenue in the profit or loss, not the entire cash receipt. Cash received does not automatically equal revenue recognized. Deferred revenue reduces current period profit compared with recognizing everything immediately. Let's compare. Incorrect treatment. Revenue recognized £24,000. Profit increases by £24,000. Correct treatment is revenue recognized £10,000. Profit increases by £10,000. Deferred revenue is £14,000 liability. Profit is therefore lower but accurate. This is one of the key reasons year-end adjustments are made. They ensure profits are not overstated. As time passes and services are provided, deferred revenue gradually decreases, revenue gradually increases. Using our example, month 6, debit deferred revenue £2,000, credit revenue. Month 7, debit deferred revenue £2,000, credit revenue, and so on. Eventually, deferred revenue balance becomes zero. The entire £24,000 has now been recognised as revenue. The obligation has been fulfilled. Let's look at mistakes usually made. First mistake is recognising all cash received as revenue. Remember, cash received does not automatically equal earned revenue. Mistake 2, forgetting the accruals concept. Revenue follows performance, not cash. Mistake 3, treating deferred revenue as an asset. It is not an asset, it is a liability. The business owes goods or services. Mistake 4, posting the journal backwards. Correct adjustment is debit deferred revenue and credit revenue when revenue becomes earned. Mistake 5, ignoring year-end adjustments. Deferred revenue is a common year-end adjustment. Let's recap. Deferred revenue arises when payment is received before revenue is earned. Revenue is recognised according to the accruals concept. Unearned revenue becomes a liability because the business still owes goods or services. Deferred revenue appears in the statement of financial position as a liability. The earned portion appears in the statement of profit or loss as revenue. As services are delivered, deferred revenue decreases and revenue increases. Always remember, revenue is recognised when earned, not when cash is received. And that's the fundamental principle behind deferred revenue. Thank you for watching, and I'll see you in the next accounting video.